Alright, welcome back. 22 points up for the Nifty, 81 points up for the Sensex. Ahead of vote on account, there is no anticipation, there is no hope rally in place with the exception of some jewelry stocks. Nothing seems to be moving in a big manner in the mid-cap space or the large-cap space. The market leadership is still with good old IT and pharma. HCL Tech is a clear outlier and Dr. Reddy excuse me, is now marching towards a new record high. But let's now bring on board the former finance minister, Mr. Yashwant Sinha, to talk about expectations from P. Chidambaram's maiden vote on account. Mr. Sinha, good morning and thank you for joining us. The market believes that the finance minister will meet the fiscal deficit target, but there are serious concerns on the manner in which government will undertake the fiscal consolidation. How could this impact the fiscal roadmap for the next government now?
You know, their policy is after me the deluge, and therefore they are freely incurring populist expenditure. They are freely postponing expenditure to the next year. You're quite right in saying that in this manner they are going to impose a huge fiscal burden on the next government. The first thing, therefore, the next government should do is to, apart from the budget, they should actually have a white paper on the fiscal situation. They should tell Parliament and the people of this country, take them into confidence and detail how this government has played havoc with the fisc in the budget. And this government must be exposed. If we don't do that, then all the responsibility and all the blame will fall on the next government, and these people will be very promptly telling the people that you know they had been able to maintain fiscal deficit at 4.8 or 4.7, and the new government has allowed it to go beyond that. So in order to meet that criticism, the facts should be clearly stated even before the budget is presented by the next government.
Mr. Sinha, hi, morning. So you're suggesting that it will be difficult for the next government to not just meet the fiscal deficit target given what it is going to inherit?
Yes, and you know, also I'd like to make the additional point that if you reduce plan expenditure by, let's say, 100,000 crore rupees year after year, what is the sanctity of the plan? There is no sanctity left of the planning process. And in fact, there is no sanctity left in the budget exercise. The budget exercise has become a fraud on the people of India.
But Mr. Sinha, in the run-up to the vote on account, the finance minister has said that he can make any proposal as long as it does not require a legislative change. Do you expect the government will make any adjustments to indirect taxes in this vote on account?
It will be very wrong if they did that. You know, I mean, there are a number of items on under SENVAT where changes can be made through a notification issued by the government. But to include such a statement or such provisions in the interim budget will be entirely uncalled for.
We're likely to close this fiscal with a sub 5% growth, Mr. Sinha. Has the economy bottomed out? Is the worst behind us? Or do you think there is more pain we're going to see in the coming days?
The worst is behind us because, you know, this government's term is coming to an end. And I hope to God that the next government one of the first things it should do, will do, is to undo the wrongs to the economy done by this government. That will create confidence in the economy, confidence in the mind of the investors, and we can move on. So the worst is certainly going to be over by the end of May, and we can look forward to a better future in the next few years.
Okay, as a politician, do you believe that there is consensus in the political class that the #1 priority for any government is now to boost the growth? Has that lesson been learnt?
Let me tell you, there are not many people in our political system who understand the nuances of economic and financial management. Having said that, if growth has collapsed, as it has indeed, then it is a matter of concern to most people. I mean, most people are worried that we have had 2 years of sub 5% growth. So growth has to be revived. I don't think there will be any opposition to growth being revived, but growth will have to be revived in a manner which will rekindle hope in the people that they are not going to be left behind in this pursuit of growth. Manufacturing, for instance, is in a crisis. Agriculture, for instance, is in a crisis. Infrastructure is in a crisis. Education is in a crisis. Now all these various kinds of crises will have to be tackled by the new government. And let me tell you that you tackle the problem of inflation and create space for the Reserve Bank of India to start reducing interest rates. And if the investors see that this is going to be the trend in future, that every couple of months the RBI will reduce interest rates by 25 basis points or 50 basis points, because inflation will be brought under control, then it will immediately create an euphoria amongst investors. So reviving growth, reviving the economy, though it is a very big challenge and there are many structural issues in the economy which will have to be tackled in the medium and long term, I am quite confident that growth can and should pick up by the next government taking some determined steps and making its intentions very clear.
Mr. Sinha, I'm glad that you mentioned inflation. How do you see the monetary policy aiding growth? The RBI wants to continue to target inflation, and the market is, pretty wary that we could see rate hikes instead of rate cuts. What's your own sense?
Yeah, there are some issues in the, if you are referring to the Urjit Patel committee's recommendations, there are some issues which should be discussed with the RBI. Targeting inflation is an objective of monetary policy, but it is not the totality of policy. Monetary policy is not the totality of the economic policy of a government, and therefore the government will have to take a number of steps, as I said earlier, in order to create the space for the RBI to start reducing interest rates. I think it's unfair to ask the RBI to, not to target inflation, even CPI, and number two, expect the RBI alone to deal with the problem of inflation. The government cannot sit back and relax and say, this is RBI's responsibility. No, it's more the government's responsibility to see that proper steps are taken, especially on the supply side, to control inflation, and thereby, as I said, create that space for the RBI.
Appreciate your time, Mr. Sinha, and thank you for joining us. About an hour or so, and then the finance minister is expected to rise on the floor of the parliament to present his maiden vote on account. Ahead of that, what is the market setup? Well, Tata Power, for maybe the right reason, maybe the wrong reason, is the biggest mover on the index, but in terms of percentage, since it's a 76 rupee stock, you cannot pay too much of importance to the percentage move there. However, Dr. Reddy is marching towards a new lifetime high. DLF is at 146, HCL Tech 1513, and ONGC is at 279 rupees. Anant Narayan, co-head of wholesale banking with the Standard Chartered Bank, joins us. Anant, good morning and thank you for joining us. The most important number, I guess, would be the fiscal deficit number. In general, the consensus view is that the fiscal deficit number will be at 4.8. If the number comes at 4.4 or 4.5, will that move the market needle?
Well, there is every chance that they show a number lower than 4.8%, given that this was a red line which Mr. Chidambaram expressed pretty strongly way back in October 2012. So we might see a 4.7 print. 4.4 frankly would be a surprise. Having said all of that, I guess the market will sort of be a little careful in reading too much into these numbers. This is, after all, a vote of account. This will have to be endorsed by the new government which comes in post the elections. And those numbers could be radically different. In fact, if you recollect, in 2009, the vote on account was very, very short of the actual fiscal deficit which emanated post the new government coming in. Now, not expecting that in this particular occasion, but the market will be wary that whatever is announced today, frankly, has to be endorsed by the new government that comes in. So expect 4.7% to be, or 4.7, 4.8 to be the actual declared fiscal deficit for this year, FY14. For the next year, we expect Mr. Chidambaram to stick to his promise of going 0.6% lower than this year's fiscal deficit. So a 4.2% target seems most feasible at this stage.
Anant, hi, morning. Do you think the analyst and market fraternity would also be very keenly watching out for the arithmetic behind the number and how the finance minister has derived at that figure? Because this year we've had successful 2G auctions which just concluded last week. You've had Balco, you've had Hindustan Zinc and the various other dividends as well for oil companies.
Right. Look, absolutely. I think there was some skepticism a few months ago on whether the disinvestment and the dividend targets would be met, and therefore would the 4.8% really be met. I think since then things have changed. We've seen dividends increase dramatically into the government, while tax expenditure, tax collections are clearly disappointing and short of budget estimates. In fact, we think it's going to be about 0.6% low of GDP, lower than the estimates. Clearly, as a combination of better proceeds from dividends and disinvestments, and most importantly from substantial cuts in expenditure, this 4.8% target will be met, if not slightly exceeded. That, of course, doesn't augur too well for growth as a whole, and for the next year's fiscal deficit either. Because if you're actually cutting down on plan expenditure, if you're postponing some of the expenditures to the next fiscal, then one would question as to what the actual quality of fiscal deficit really is. I think the other thing which is worth probably watching out for is the way the revenue deficit pans out. While the fiscal deficit has come down over the last three fiscals, from 5.7 to 5.2 and probably 4.8 or 4.7 this year, the revenue deficit actually has remained pretty much unchanged at the 3.5% mark. In fact, we expect it could actually be higher this year at closer to 3.8 or 3.9%. That's not a good sign again. If you're actually borrowing from the future to pay for this year's current expenditures and cutting down on plan expenditures, that's a bit of a bad sign as well.
What about the direct tax number? The assumption for FY14 when the year started was 18-19%. There are estimates which are indicating that the direct tax collection for this year will fall below 10%.
That's right. We expect it to be in the 9.5% or so range. I think the projections for the next year would probably be closer to the 15% mark, well short of the 19% which was budgeted for FY14, but higher than where the actual numbers this year could end up being. As I said, this year's revenue collections have clearly been disappointing. Tax revenue collections have been disappointing. We think there's a slippage of about 0.6% of GDP on that score alone. Next year, I think 15% is probably more realistic. At the same time, it would mean a marked improvement over the actual numbers realized in FY14.
And finally, what are your estimates for FY15 gross and net borrowing? Because that's the tricky part, because that is one number which I'm sure will be challenged. And do you think the bond yields today could move based on next year's borrowing number?
You're right there. I think the market is expecting between 6.2 trillion and 6.4 trillion of gross borrowing. We actually expect slightly lower at 5.8 to 6 trillion rupees or so. It's an assumption that we've made that the cash balances that the government will take into the next fiscal will actually be drawn down during the course of the of FY15. It's an assumption which might not come true, but if that comes true, because the redemptions in April 2015 and May 2015 are on the lower side, so it doesn't really need to carry so much of cash in the next fiscal, then you could actually see a smaller gross borrowing figure being declared today. Having said that, as I said right in the beginning, the government, the market would take this with a pinch of salt. The reality is the final numbers will need to be endorsed by the new government. And if the new government starts off by saying that, there is a lot of fiscal adjustment which needs to be done and therefore the projections don't really bear out, then the numbers could change. So even if you do announce a 5.86 trillion number today as a gross borrowing, which is much better than what the market expects, don't expect bond yields to come down too much. I think there'll be a healthy amount of, carefulness in the market about reading too much into the numbers which come out today.
And how I wish we had more time at hand, but I'm afraid I'm going to have to let you go on that note. Thanks really a lot for taking time out and joining us today. That's the view coming in from Swaminathan Aiyar. Well, tempered down for the markets. So let's bring on board Mitesh Thakkar and talk about his trading ideas. Mitesh, you have 10 seconds in all.
Yeah, I have a buy on HCL Tech with a stop at about 14.99 for targets of 15.60. Cox and Kings is a buy with a stop at 140.5 for targets of 156, and Indian Hotels is a buy with a stop at 58 for targets of 66. Okay, quick break. When we come back, talk to Shankar Sharma of First Global, Saumil Shah of Bank of America Merrill Lynch, Mukesh Bhutani from BMR Advisors, Swaminathan Aiyar, consulting editor at ET Now, and Punita Kumar Sena of Pacific Paradigm Advisors.